Today, hot inflation left markets sanguine. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the US Bureau of Labour Statistics reported that in December, the consumer price index for all urban consumers rose 0.5% seasonally adjusted and rose 7% over the last 12 months, not seasonally adjusted. The index for all items less food and energy increased 0.6% in December, that's season adjusted, up 5.5% over the year, and that's not season adjusted. Now that result is the fastest 12-month pace in nearly 40 years during December and was consistent with expectations. Economists surveyed by Dow Jones had been expecting the gauge to increase 7% on an annual basis and 0.4% from November. The annual move was the fastest increase since June 1982 and comes amid a shortage of goods and workers and on the heels of unprecedented cash flowing through the US economy from Congress and the Federal Reserve. The December CPI report of a 7% increase over the last 12 months will be shocking for some investors, as we haven't seen a number that high in almost 40 years, said Brian Price, Head of Investment Management at Commonwealth Financial Network. However, this print was largely anticipated by many, and we can see that reaction in the bond market as longer-term interest rates are declining so far this morning. Food prices broadly rose 0.5% for December and were up 6.3% on a 12-month basis. That's the biggest rise since October 2008. Excluding food and energy prices, so-called core CPI increased 5.5% year over year and 0.6% from the previous month. That compared with estimates of 5.4% and 0.5%. For core inflation, it was the largest annual growth since February 1991. Shelter costs, which makes up nearly 1/3 of the total, rose 0.4% for the month and 4.1% for the year. That was the fastest pace since February 2007. And as we know, that particular set of data is delayed, so expect strong future growth. In fact, shelter costs, which were already one of the largest contributors to December's gain, are expected to accelerate this year, offering an enduring tailwind on inflation. Other gauges of home prices and rents surged last year, but the full extent of those increases have yet to be reflected in the government's measures. Used vehicle prices, which have been a major component of the inflation increase during the COVID pandemic due to supply chain constraints that have limited new vehicle production, rose another 3.5% in December, bringing the increase from a year ago to 37.3%. Conversely, energy prices mostly declined for the month, falling 0.4%, as fuel oil was down 2.4% and gasoline fell 0.5%. But the complex as a whole rose 29.3% in the 12-month period, including a gain of 49.6% for gasoline. Fed officials are watching the inflation data closely and are widely expected to raise interest rates this year in an effort to combat increasing prices and as the job picture approaches full employment. Though the central bank uses the Personal Consumption Expenditure Price Index as a primary inflation measure, policymakers take in a wider range of information when making decisions. This morning's CPI read really only solidifies what we already know. Consumer wallets are feeling pricing pressures, and in turn, the Fed has signalled a more hawkish approach. But the question remains if the Fed will pick up the pace, given inflation is seemingly here to stay, at least in the medium term, said Mike Lohengrat, Managing Director for Investment Strategy at E-Trade. With COVID cases continuing to rise, the impact on the supply chain and labour shortages could persist, which only fuels higher prices. Inflation has been eating into otherwise strong wages growth for workers. However, real average hourly earnings posted a small 0.1% increase for the month, as the 0.6% total gain outweighed the 0.5% CPI headline increase. On a year-over-year basis, real earnings declined 2.4%, according to BLS calculations. Fed officials largely attribute rising inflation pressure to pandemic-specific issues, in which a shortage of workers has led to clogged supply chains and empty store shelves. Though there are signs the Omicron variant cases could peak soon, lingering COVID issues combined with cold weather in the northeast point to renewed upward pressure on food prices, wrote Paul Ashworth, chief US economist at Capital Economics. Investors largely expect the Fed to start raising rates in March. Fed Chairman Jerome Powell, at his confirmation hearing on Tuesday before the Senate Banking Panel, did not provide any specific dates, but acknowledged that as long as current conditions persist, rate hikes are on the way. If signs fail to materialise that inflation is moderating, Federal Reserve policymakers could be forced to embark on a steeper path of interest rate hikes and balance sheet shrinkage. It would also make it even tougher for President Joe Biden and Democrats to retain their congressional majorities in November's midterm elections or pass their tax and spending package. The breadth of gains in recent months gives inflation inertia that will be difficult to break, said Sarah House, senior economist at Wells Fargo. We expect the CPI to remain close to 7% for the next few months. Whether inflation falls as expected will depend on supply chains normalising and energy prices levelling off, but higher rents, robust wage growth, subsequent waves of COVID-19 and lingering supply constraints all pose upwards risks to the inflation outlook. While moderation is expected in some categories like vehicle prices and apparel, there's no particular reason to expect much of a cooling for the rest of the core. Stephen Stanley, chief economist at Amherst Pierpoint Securities, said in the note, "Sure, there will be good categories that cool off once supply bottlenecks begin to ease later this year, but at the same time the pressure from wages on prices is only going to ramp up," he said. Omicron is poised to further disrupt already fragile supply chains, due in part to quarantines and illness that have prevented many people from working. It also curbed demand for services like dining out. The daily gross domestic product tracker suggests activity was down sharply in the first week of 2022. With Omicron hitting the supply side of the economy through staffing, inventory levels are likely to take even longer to normalise as a result, keeping up with pressure of goods prices through the year, House said. That's likely to be coupled with stronger services inflation. Last year, the increase in the CPI was largely due to high goods inflation, excluding food and energy. The agency's price index for goods surged 10.7% last year. That's the largest 12-month advance since 1975. Services costs climbed 3.7%. The annual jump in US goods prices was the largest since 1975, outpacing services. Despite the strong CPI outturn gain, stocks rose after the news, while government bond yields were mostly negative. So the investors were really not spooked at all. The S&P 500 rose 0.3%, the Dow Jones Industrial Average gained 0.1%, and the Nasdaq added 0.2%. Following the inflation report, Treasury yields continued to slip, with the 10-year back down from 1.8%, paving the way for an ongoing recovery in tech. Big tech was mostly higher, led by Alphabet, although Meta Platforms was the exception, down around 0.3%. Tesla, meanwhile, jumped about 4% a day after receiving a price upgrade from Morgan Stanley to $1,300 per share from $1,200. A fall in healthcare kept a lid on gains in the broader market following a more than 7% slump in Biogen after Medicare said that it planned only to cover the company's Alzheimer drug Aduhelm for patients enrolled in approved clinical trials. And PayPal slipped 2% after Jefferies downgraded the company to a hold from buy and cut its price target on the stock to $200 from $255, citing a cautious fundamental backdrop in 2022. Energy was flat, even as oil prices neared 2-month highs, following a larger than expected draw in weekly crude inventories. Energy prices would likely continue to surge as demand from economic reopening and reflation collides with a cold snap and tight supply in the northeast region, January Montgomery Scott said in the note. We remain bullish on crude oil prices and expect targets towards the $85 to $90 in 2022. And gold was up a little, just 0.4% to 1,825. Federal Reserve Governor Laurel Brainard is expected to stress the central bank's priority to get inflation back down to 2% while protecting economic gains already made to support a full recovery. Inflation is too high. Our monetary policy is focused on getting inflation back to 2% while sustaining a recovery that includes everyone, Brainard said in prepared remarks for a confirmation hearing before the Senate Banking Committee slated for Thursday. The remarks arrived just as data showed that this US inflation rose 7% for the year through to December, the fastest pace since 1982. Today, the economy is making welcome progress, but the pandemic continues to pose challenges. Our priority is to protect the gains we've made and to support a full recovery, Brainard said. The Fed governor will also point to the progress made on the Fed's labour market objective, which forms part of the central bank's dual mandate. We are seeing the strongest rebound in growth and decline in unemployment in any recovery in the past 5 decades, according to remarks from Brainard. Over the past year, unemployment has fallen by 2.8 percentage points, and growth is estimated to be around 5.5%, according to a variety of private forecasts. So the story is continuing, really. CPI is up, probably understating the true situation. It will go higher. The Federal Reserve will have to react and lift interest rates. But of course, how far they can lift interest rates is the key question now, because even if they lift rates to relatively small levels, that could act as a significant brake on the economy. And if they also reduce their quantitative easing programs, that could have a significant impact on the broader markets. So everything here points to more volatility, more uncertainty ahead, but this CPI number is one to take note of. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.